Welcome to Africa Ascending, a podcast series looking at key issues affecting the African business environment, and more particularly its impact on the insurance sector in Africa. Hosted by Afro-Asian Insurance Services and Africa Ahead, in this series we'll be looking at everything from war to regulations, currency devaluation, and climate change. To access this podcast in other ways, we will be appearing on Africa Ahead, www.afapublishing.com, Spotify, and on the media page of Afro-Asian-insurance.com. My name is Liz Booth, and I'm the editorial director at Africa Ahead. With me, I have
Uday Patel, Chairman and CEO of Afro-Asian Insurance Services Limited.
Today, we are talking about alternative risk solutions and the need to think outside the box. To do this, we have Phocas Nyandwi, Africa Re. Phocas started his career in direct insurance in Burundi. He was recruited by Africa Re in 2010 as treaty and facultative underwriter in the Nairobi regional office. After a long spell in head office, Phocas has recently returned to Nairobi, where he sits as regional director. And we have Zeeshan Ahmad, head of treaty and structured solutions at Afro-Asian Insurance Services. Zeeshan started his career as a business analyst in India before joining GIC Re. After a spell as chief underwriting officer in South Africa and then a return to India, Zeeshan joined Afro-Asian in London. Welcome to both of you. So, Zeeshan, if I could turn to you first and ask, what are the alternative risk solutions? What do we mean by that? And what are treaty structured solutions?
Alternative risk solutions are non-traditional insurance and reinsurance solutions that actually complement the traditional solutions that we have in the insurance and the reinsurance space. With the kind of uncertainty we have seen in the insurance and the reinsurance markets for the last few years, these alternative solutions have become much more prominent, and people are looking up to address some of their insurance needs with the help of alternative risk solutions. Having said that, traditional solutions are always going to be there. They haven't become obsolete, but they need to be complemented with better strategies to transfer the risk and finance the risk. In terms of the specific solutions, there are multiple solutions that can address various needs of the insurance buyer. It could be an insurance company looking to buy reinsurance, treaty, or facultative. It could also be a reinsurer who's looking to address their retrocession needs with the help of alternative risk transfer products. So it could be in the form of structured solutions, which is a kind of blend of risk transfer and risk financing. Then it could move on to more advanced alternative products like cat bonds, wherein you actually transfer your insurances to the alternative markets, maybe capital markets, maybe pension funds who want to come in and invest in those risks. It could also be in the form of parametrics, and then more specifically in most advanced markets, it could be in the form of insurance-linked securities, ILS. However, specifically to Africa and for the treaty solution needs in Africa, what we have seen in the recent times, that most buyers are interested in structured solutions, wherein they try and optimize their treaty reinsurance needs in the form of cost efficiency and the amount of risk transfer they can make. What has been seen over the recent past is that the market has become very hard. And because the traditional capital has not been growing, rather it's been on the decline for quite some time. And that's the reason the prices have gone up. And some of the buyers are finding traditional covers either not affordable or not available at all. So to complement the needs of their traditional risk transfer solutions, structured solutions are coming in handy, wherein the risk could be managed with very low cost in case the claims experience is favorable to the reinsurers.
Thank you. Phocas, perhaps I can bring you in here. I was interested to know a little bit more about the drivers of this, and Zeeshan's touched on it a little bit there. Would you agree, is it the cost of capital in the traditional market, a lack of capacity, or not enough new capital coming in? Where do you think the driver is for this?
I would say two major drivers. One is the insufficient capital to cover some of the risks that our markets are facing. I'll give an example, like the earthquake in Morocco in September last year. We definitely could see that the limit that was there was not enough to cover an event that was not the worst case scenario. So meaning, if the cost is affordable, depending on the capacity in the market, it's possible to look at alternative solutions like cat bonds to complement the cover that is there. There's also an element of cost, of course, because such solutions, in most cases, appear to be more attractive, especially in a hard market spell like we are in. Unfortunately, I think the market is still somehow struggling to understand how those solutions work. So, meaning there's need for more awareness of what are the available solutions for the market to harness fully these alternative solutions. Thank you.
Thank you. I was wondering whether these solutions are right for companies of all sizes, or if they're better suited to a certain style of company. Does it work for small companies and large companies? Who are the people who will look to these solutions mostly?
Basically, alternative risk solutions are extremely tailored, bespoke solutions, and that can suit the size and scale of any business. It could be a large company, small company, just a portfolio, captive. Whichever way you like to design a solution, there are ways and methods available to make it very tailored and customized, fit the size and the scale of the business.
I'm interested to hear, Zeeshan, that you said it is suitable for large and small companies, but surely premium volume has an impact on it, doesn't it? I mean, if you're a small company with a small premium volume, would you want to go down the structured solution route where possibly the benefits are minimal for you?
In fact, it works very well for companies who have smaller volumes. I would imagine a small company starting afresh, maybe 2 years into the business, writing multiple classes of businesses, but still with very low volume coming into each class of business. In such a case, trying to arrange a standalone traditional treaty for each class may be very expensive. The best solution there is to combine all classes on a whole account basis and go the structured solutions route, wherein you will take the advantage of diversification of the whole portfolio because multiple classes are coming in. And at the same time, you will have the benefit of optimizing the cost because you are buying one cover across all your classes of business.
Yeah, I agree that it can work for large and small companies and also for treaty as well as facultative. However, more often than not, especially in Africa, you find that larger companies also have more sophistication and more likely to tap into such kind of solutions because they have the knowledge, they have the negotiation power. But that does not mean that it's meant for large companies only. It's just a matter of fact that they are the ones who can invest easily in those solutions, get the knowledge required to be able to tap into them.
Can I just refer to the elephant in the room here? Now, we're talking about structured solutions, alternative risk transfer solutions, and all that. But with all the countries in Africa, they've got regulators. do regulators actually understand these concepts and these products? I would be interested to hear some comments.
It's a challenge. Some regulators, I wouldn't make a global statement to say regulators understand or don't understand. We've had examples of regulators who are very innovative, who even have put in place some mechanisms of encouraging innovations or some kind of covers. Like, for example, I will still give the example of Morocco. We also have examples in Africa where we have innovation labs. However, in general, if we are talking about Africa as a continent, there's a challenge for regulators to understand a product in order to approve it and give it the necessary incentives to be able to work. And it usually takes time to explain and get the structure understood, even when such solution is for the benefit of the whole country. But I think more and more we've seen for the last few years in some forums, discussions around that. And I think the future is brighter than we may think.
One of the things that we seem to touch on every time we do one of these podcasts is skills. And I'm wondering, there's often a conversation about the level of skills. There's the level of talent in Africa that's clear for everybody to see, but the level of skills are not necessarily at the same level. So do you need that skill to be able to make these work? And is that skill widely enough available in Africa, do you think?
I think the topic of alternative risk transfer solutions is not new to Africa. I mean, it's been years and years that this topic has been discussed across various forums. The kind of training we have seen that is happening across Africa, I think alternative risk transfer solution has been one of the important topics being discussed and shared. However, skills are built, skills are developed only when you have actual application of certain theoretical topics into the industry. I would imagine that skills have been developed over the last 2 decades or so in Africa. However, we need some application of those skills to actually test the level of skills which is actually there for topics like alternative risk transfer solutions.
After the last global banking crisis in 2007-2008, the capacity for ART solutions was reduced considerably because of the financial losses suffered by various institutions. What I was wondering was whether it's time for the insurance sector to start examining those opportunities again in association with the banking community and to revive the use of those instruments.
Certainly, I think it's a question that is valid in relation to the kind of existing capacity, the capital relative to the traditional capital. It's a matter of understanding and also risk appetite. So far, the capacity has been channeled through products that the traditional reinsurers understand and can price better. There's no critical mass data for alternative risk solutions for reinsurers to be able to model the risks. Actually, if at all, like I think Zeeshan referred to parametric solutions, we are using actually the science to be able to model. Unfortunately, what happens is that when loss do happen, you see a hike of prices to try and recover some losses in the shortest time possible. But I agree that we need to try understand better. We need to, so that we also channel the capacity in those solutions, because so if you can see for the last 20 years, we've been talking about it, yet if you see the capital going into this line, it's very small. yet it's something we could look into and that can provide and complement the capacity we have, which sometimes dries off.
I tend to agree with Focus that over the last 20 years, we have been talking and talking, but not enough implementation has been there in the industry. While it's very important to take cues from other industries like banking, the crisis, and the problems associated with such solutions, I think it's also important for the insurance industry, particularly in Africa, to take lessons from other markets. I mean, the concept of alternative risk transfer is quite broad. And if you look at the different products that are categorized as alternative products, it's a long list of products. So the most advanced products wherein the risk gets transferred to the capital markets like CAT bonds or ILS, I mean, possibly we could get information from the banking crisis and analyze those products. However, in Africa, the concept is still relatively new. And the most fundamental type of alternative risk solution that could be easily implemented in Africa could be the structured solutions. We have seen that some companies have opted for structured solutions, especially for their treaty needs, mostly in the form of multi-year, multi-class aggregate solution basis. And it's been working very well for those companies because the upside and the downside is pretty limited for both the parties. What such solutions do is to regulate the cost and benefit over a longer period than a traditional annual treaty. So I would expect such solution to become more prevalent because the risks are relatively lower, and we would need such solutions to be implemented across various markets, across various products, see the real impact of how capital utilization is happening on a regional basis. If you pull in all the reinsurance capital available for Africa or for a small region in Africa, I would like to see how much saving we can make to the overall capital using the alternative risk products. Going into the more advanced products like parametrics or CAT bonds, I think, yes, it's important for the industry to move with caution, learn lessons from other markets and other industries, possibly banking, before going in to such solutions full throttle.
Can I just jump in here with a comment and an observation? So, Liz, you mentioned about the global banking crisis, 2006, 2007, prior to which there was a prevalence of use of ART mechanisms to offload risk. Now, one of those in those days, which was quite popular, was a sidecar arrangement. Now, the question I have here is, especially in the South Africa market, where solvency is a big thing for insurance companies. If you have a matured portfolio where you have part of it is comprising toxic risks, and you have now, of course, IFRS 17, where you've got to make provision in terms of additional capital to possibly address the negative aspects of the risks that you're carrying. Then is there a future there for a mature insurance company to improve its solvency, creating a sidecar which is totally outside its balance sheet, and offloading the toxic portfolio into the sidecar, and thereby overnight improving its solvency?
Certainly, Uday. And this is a topic which has been discussed widely over the last few years, especially when most countries have implemented IFRS, and then the regulators across Africa are looking at the risk-based capital supervision more on the lines of Solvency II of the European Union, wherein the capital, becomes more stressed because you've got to quantify all the risks. So efficient capital utilization is the buzzword. we've seen that a number of companies, not just insurance companies, but also some large corporates who otherwise buy insurance, are looking at captives for their risk solutions. Now, more importantly, for insurance companies having toxic assets, or having a portfolio which is not really helping them with their solvency relief needs, they might like to put such portfolios in the form of captives and arrange alternative risk transfers like adverse development covers, or stop loss covers, or loss portfolio transfers on a structured basis. And by doing that, they will be able to free up the capital available otherwise for their main portfolio.
Thank you, Zeeshan. I always feel with these conversations, we've only just scratched the surface and there's a lot more to say, but we are out of time for today. So I'm going to hand over to Uday to wrap the conversation up for us. Uday, over to you.
Thank you very much, Liz. And this has been a most enlightening session. And I want to thank both Zeeshan and Phocas for contributing so heavily. We spoke just briefly, if I may summarize, we spoke on different types of structured solutions. We also concluded that these solutions are not just a prerogative for the large companies, they are also suitable for small companies, for both treaty and facultative business. The drivers Phocas mentioned were cost of capital, availability of capital were the main drivers. Forgive me if I've missed out on anything. Generally, we also recognize that there is a challenge for regulators to understand the concept of alternative risk transfer solutions. However, there are some who do understand and who are progressive, but Africa-wide, it is still a challenge. And also, post the last global banking crisis in 2007, we also concluded that it's probably time for the insurance community to start cooperating with the banking community as they did before, to look at new ART products. One example that we discussed was the possibility of sidecars being used to improve solvency ratios. So thank you very much to the both of you. And thank you to all our audience. I would like to conclude by saying, remember, folks, at Africa Ascending, we ask the difficult questions in the hope of finding long-term solutions. I hope that you can join us next time. Goodbye.